Stop watching the price of money. Stop watching charts, headlines, and interest rate predictions. Those are the last signals to move. The real story isn't price. It's plumbing, custody, payment rails, and settlement. This is part one of a 3-video arc explaining how the global monetary system actually breaks. Most people watch price, so they think a bank deposit is their money. People who understand the system know the truth. A bank deposit is an unsecured loan to a highly leveraged institution. And that institution's funding model is now under direct attack. The damage is already done. In March 2023, Silicon Valley Bank saw $42 billion in deposits attempt to leave in a single day, with another $100 billion queued behind it. That wasn't a classic bank run. It was a digital bank run. It showed what happens when depositors discover an exit. That exit is the stablecoin. And it threatens to make the cheapest funding source in banking simply evaporate. To understand the threat, you first need to understand the lie. When you deposit $1,000 into a bank, you are not storing your money. You are making an unsecured loan. Legally, the moment you deposit cash, ownership transfers to the bank. You become a creditor. The number on your screen is not money. It's an IOU. This is the foundation of fractional banking. For decades, banks were required to hold a fraction of deposits in reserve. But as of March 2020, reserve requirements in the US were set to 0. The system now runs almost entirely on confidence. Banks borrow short, your deposits payable on demand, and lend long into 30-year mortgages and multi-year assets. This is called duration mismatch. It only works if depositors stay put. It only works if leaving is hard. It depends on one thing above all else: lack of choice. Stablecoins introduce that choice. A stablecoin is a digital token, typically pegged 1-to-1 with the dollar, and backed by cash and short-term government securities. But its power isn't crypto speculation. Its power is structural. Stablecoins unbundle the 3 functions banks have monopolized for over a century: custody, payments, settlement. Banks force a package deal. To pay, you must store funds with them. To store funds, you must settle inside their system. Stablecoins sever that bundle. They prove you don't need a bank to hold, send, or settle value. And if you watch this channel, you already understand the implication. Plumbing is not a detail. It is everything. First, custody. With a bank, you hold an IOU. They hold the money. They set the rules. They control access. With a stablecoin in a self-custodied wallet, you control the keys. It's the digital equivalent of holding cash in your hand. You are no longer a creditor hoping your debtor remains solvent. Next, payments. Bank transfers are slow by design. ACH takes days. Wires work only during business hours. Stablecoin payments operate 24/7, globally, settling in minutes for pennies. This isn't a faster message between banks. It's the transfer of a digital bearer asset. The toll booth disappears. Now we reach the kill switch: settlement. In the traditional system, settlement happens inside bank ledgers. Money moves between balance sheets, but never leaves the system. That's how the funding pool survives. Stablecoins break the loop. When a stablecoin transaction settles on a public blockchain, value exits the banking system entirely. That is funding evaporation. Picture a bank with $100 billion in deposits. If depositors move just 10%, $10 billion, into stablecoins for speed and control, that funding is gone. The bank must shrink lending. Funding costs rise. Credit tightens. At scale, the credit engine stalls. This isn't ideology. This is mathematics. The system knows this. Banks are racing to create tokenized deposits, blockchain-styled IOUs that keep settlement trapped inside their balance sheets. They are also fighting through regulation. New stablecoin rules explicitly restrict issuers from paying interest directly to holders. Mechanically, this limits competition with bank deposits, protecting funding, not consumers. At the same time, a new fragility appears. Stablecoin reserves are concentrated in a small number of banks. A redemption wave could trigger a compressed bank run faster than anything seen before. The system is adapting, but defensively. For over a century, banking worked because there was no alternative. Your money was trapped in a permissioned system, making fractional lending possible. Stablecoins expose the lie by offering an exit. Banks aren't afraid of crypto. They're afraid of settlement outside their walls. This channel is for settlement watchers. We understand that once enough depositors choose freedom, the funding beneath modern banking evaporates, not with a crash, but with better plumbing. And when that funding evaporates, the first thing to break isn't a bank. It's a physical commodity market everyone assumes is untouchable. Watch the next video now, where we explain why the silver delivery market fails first when liquidity leaves the system.